you want to go. Yeah, no worries.
Cool. So, first of all, I mean, I'd say, Rob, congrats to such an amazing podcast that you run. I really like your stuff, and the way that you interview people actually is really good. And you're doing this for the community, so big thanks. I'm a software engineer. I'm Michael. So I live in London. I live and work here. And like you said, I mean, I'm not the finance guy. I'm probably more of a software engineer than a finance. But I just happen to follow a path that led me to invest more than my colleagues, let's say, that I used to work with at the time. And put a different approach to how I invest, and perhaps how I approach the wealth that software engineers can get. And that's not just because I'm special. That's definitely not the case. It's probably because I just I got hooked to this financial independence mindset that lets you be grab more freedom and be more optimistic when it comes to finances, let's say.
Okay, sweet. All right. So, question just off the top, before we jump into it: how much of your time now is coding, and how much of your time is like what I essentially assume is your side hustle in terms of the finance stuff? Yeah.
No, I would say that most of my time is coding. Okay. The finance side of things is probably, I don't know, 20%, and mostly weekends and some nights and occasional days. But I'd say that most of my time is still spent doing software engineering, and I love the craft. I love creating things. At the same time, I want to do more things with the money that's left behind. And I'd say that this is why I have dedicated some of my free time to wealth building and building a community for that, and all the other side hustling that I'm doing.
Okay, cool. All right, so I want to get into the side hustle, but just again for people that are listening, because you mentioned wealth building, right? I have a pretty good idea knowing who you are and kind of being on that path of what you're talking about. But there's a lot of developers. I would imagine there's a lot of people listening to this that, at least in UK terms, don't even have an answer or don't understand the idea of what they could be doing. So what is wealth building to you, or how would you explain it to somebody who has no concept essentially of what it is that we're talking about?
Yeah, I mean, I would say, in plain English, I would say that wealth building is making your money work harder for you, and just doing things a little bit different to just approach the finance side of things like a business, like an optimization technique, let's say. We're software engineers. We like to optimize things. We like to leave the room better than we found it, and all this. And when it comes to finances, I'd say that personally, I also like to optimize this area, and perhaps do more with my savings, or have savings in the first place. So have savings in the first place, and then see how I can use my savings to just give me more freedom in life, and not just to me but my family as well. So I have a 3-year-old and a lovely wife here in London. So yeah.
Nice. Okay. All right. So then, how did you get into? Because I assume you didn't, and correct me if I'm wrong, because you have a blog, right? And I assume the intention when you started the blog was not, or if I'm wrong, let me know, that it wasn't like, oh, I can turn this into a business. I would assume it was, oh, 1 second, someone's wandering in.
Yep.
All right. I thought it was the dog for a minute. I was like, oh, she's got thumbs. That's weird.
I've got a cat here, but thankfully he's quiet.
Oh, okay, cool. Yeah. The dog's super quiet as well if she did wander in, but she also likes to open doors and stuff. So, so yeah, I assume the intention wasn't like, oh, I can turn this into a business. It was just writing about stuff that you were learning and sharing it with the community. So how did that kind of morph itself into what Foxy Money is today?
Yeah. So FoxyMonkey started as more like a blog to write my thoughts and basically seek feedback, right? So one of the best things of writing is that you can structure your thoughts. Okay, so you can basically see if you understand the problem as well enough, basically, and then only when you try to write it and explain it to others, you'll see if you can understand it well enough, and then B, also get feedback on my approach and tell people what I'm doing in order to get feedback and help them as well, because a lot of people came to me and asked me about guidance and what else is out there, and what to do with my savings as a freelancer and things like that. And now when I had like a core structure in place where I had a few articles out there, I could just point them to an article. Then that probably explains it better than I will do at that point in a pub or something. So it became something of more like a habit to document my journey and help others. So that's how it started, and eventually that grew into more more people that I didn't know reading my stuff, thanks to SEO and Google, and people spreading the word, basically Reddit as well, and people started needed, I guess, something more from it. So a lot of people were complaining to me about their accountants, and that I should get on one-to-one with them and help them. So I kind of started basically, telling people in a more private way or over emails, helping them over emails, or recommending professionals. And sometimes professionals didn't do a good job, so they were kept looking for more. So it evolved throughout the years. I think it started in 2016, so 6 years now into it, and it became more of a place that contractors, business owners, agencies come to find more information about how to combine the business side of it with the investing side of things, particularly when it comes to companies and business investing.
Okay. All right, cool. So to get into it a little bit, so what kind of so for people that listen that aren't freelancers or aren't in the UK, and I'm sure this stuff applies like worldwide, but it will be worded and stuff slightly differently. But in the UK, if you're a contract developer, you work for a limited company, right? So what often happens is you get paid X amount of money, you pay yourself a tax-friendly salary, which in the UK caps out about £50,000 depending on the year. And then if you made more than that, then you might end up with 10 or 20 or whatever you have left in your bank account, in your business bank account, just sitting there doing nothing, essentially waiting for next year for you to take that money out again. So what kind of strategies do you recommend people can do with that money? Like, what are people's options? Because like I went through the kind of the usual stuff, right? Like, okay, you pay yourself a tax-friendly salary. All right, check. What else can I do? Okay, cool. You can top up your pension. All right, check. What else can I do? And then there's like, you can throw a Christmas party just because, that's a couple £100 that you can use on that. And you can do like trivial benefits and buy yourself an Amazon gift card every now and again and things like that. But at some point it becomes like, there's not really that much more you can do. And you still have this sum of money just sitting there, and you can either pay yourself the money and give a big portion of that to the tax man, or you can do other things. So what are the other things that people could be doing with that money?
Yeah, that's a very good question, Rob. And in fact, this is where accountants basically start becoming more of a naysayers than come to me to build your wealth. Because I say the company, those contractors, and as we said in the UK, there is this company surplus that remains in the company. Those people basically need someone not to tell them where to invest, but actually what the implications are of investing. It's not as simple as, here in the UK we have the ISAs, right? So the individual savings account, which is a tax-free wrapper. So it's not as simple as just opening an account and just putting the money in there. There are tax implications for doing it, in the company, and there are different ways to, and different pros and cons between the approaches. One approach is to just open a company account and invest the amount of money there. This is like the most direct approach, the simplest approach that you can follow. It comes with some problems because you're as a business owner, your business is basically in the trade of providing software services to others and other projects. It's not of that of investing. So once you do it in a big way, once you invest a substantial amount of your business, then it stops being a trading company. It loses what's called the trading status. And here in the UK, losing the trading status means that you lose certain benefits that the company has for being in a trade. So you're losing your ability to claim entrepreneurial leave.
Yeah.
Basically losing the ability to close down your company and do it in a tax efficient way, in the most tax efficient way. And you lose some other benefits like your inheritance. So trading companies can benefit from what's called the business property relief, which is related to inheritance. Again, more long term, but still applies. It's something that it's not part of your trade. So there are other approaches to it, such as opening a different company to separate the trading from the investing part. Okay. So this different company can be either a separate company that you via loan, so you lend the money from your trading company to your investing company, or it could be a group structure. So you can set up a group that have companies such as a parent company that does investing and a subsidiary, which is your trading, that keeps trading, as it used to. So there are pros and cons between these approaches, but the main thing is what you're trying to get out of it, when you need the money, because some people might say, I definitely want to invest, but you know what, I'd like to close the company down in 2 years.
Sure.
And investing, won't move the needle that much. If something, it will be risky to invest if you plan to close down the company in 2 years. So there are different approaches to it, and this is what this is why I try to structure all the things in a more in a course that I created, because it's not easy to explain, let's say, in 5-10 minutes conversation what the tax implications are. It's definitely not as simple as an ISA is, but it's not as complicated as you might think. So and if you look at with the long-term dream and long-term goal in mind, then the benefits are there rather than just taking more money out of the business and paying the dividend tax. And basically what you do here is you defer your dividend tax, you defer the taxes for later on, rather than paying the tax now and investing. And of course, people should definitely seek advice and when doing this. And the problem, at least here in the UK, is that unfortunately most accountants don't help much in this area. Sometimes they don't know, sometimes they don't want to get involved in take risk for their clients, and it's sometimes they don't act as tax advisors, let's say, right? So the bookkeeping part, they are in a special area and they don't want to move out of their comfort zone. But of course this creates problems, this creates opportunities as well, and I think that taking the time to learn what you can do and what can investing do for you and your future goals can pay dividends big way, literally and figuratively. So.
Okay, sweet. All right, so I want to ask a couple of questions about that. But first thing, so I messaged you. So I found out about your course, and I knew there was a course happening. I think the last one was like May or June, as we record now. And I was like, all right, I'm going to get on that. But I kept I'll sign up tomorrow. And then it was closed. It's like, you filled the spaces. Cool. I have to wait for the next one, right? Yeah. and then I remember all right, I was looking into it a little bit, but how difficult or not was it for you? Because like you said, right, I've recently switched accountants because I had an accountant from when I started my business, which was like 2013 up until last year. And then they got a bit expensive and I found an alternative. So I was like, all right, cool, I'll switch. I switched to another accountant. These guys were a very bad decision. So then now I switched again and like within the first conversation with my new accountant, I'm like, all right, cool. This was a good decision, right? But still having what I would consider, you know, quote unquote, good accountant, I'm not going to get the knowledge from him or the advice from him about the things that you talk about, because I've asked, like, what do you think about this? And you just basically get like a blank response. Like if I tell them, can you please do this thing for me, they'll do it. But if I ask them, like, what are my options? They're just like, I don't know. So how hard was it for you to figure out all of this stuff? Because it was essentially like you doing your own research into like tax code and stuff, which is not straightforward.
It wasn't fun. That's for sure. Because it was like, you know, going in dark, and I would happily pay actually if there were professionals. I'm sure there are professionals out there that do it.
They're just probably not that easy to find. I would think is the case.
These people are not easy to find, and perhaps when you find them, they're very expensive. And perhaps because they're very expensive, they only deal with bigger companies, so they don't deal with this middle ground of, I don't know, consultants and you know, perhaps doctors that they have limited companies and these sorts of businesses. And this was, you know, quite hard to find. So I was basically, you know, doing and learning at the same time. And I'm glad I found an accountant to help, but at the same time, I had to do a lot of research. Trust me, I had to spend hours forums, reading HMRC documents, guidance, consultations, summaries from HMRC, all sorts of things, and trying to understand the area a little bit better. And as I wrote about it more on the blog, then as this became more popular, and there is an article that has more than 300 comments on it and long discussions about things, I was refining my knowledge and, you know, writing down things in my let's say local library. I basically did the research, which is ongoing. It never stops, as this landscape keeps changing and always changes. Which is what, you know, having a community, not only on the blog but also as a you know, course community, helps to help each other and you know, grow together. Basically, otherwise it's really hard. So overall, yes, it was hard. It wasn't fun, but when I saw the impact, it was so rewarding, because you cannot imagine how many people are in a situation where they, as you said, they take out, let's say, a minimum salary of £12,000 or something, and then dividends up to £50,000, and then the rest is you know, little trivial benefits or perhaps some pension. And then they are, you know, I had colleagues that just either were taking the entire amount out or were paying the highest dividend tax, and then were, you know, doing whatever they wanted to do, or they were just leaving the money inside the company, and this ended up having a big surplus. If you see it in 2, 5, 10 years down the line, you had a big surplus that's just idle, doing nothing. Bank accounts pay zero these days. Now with interest rates changing, they might pay like 1 or 2%.
I was going to say,
but still, right? And it was a painful but rewarding experience, I'd say.
Okay, all right, that's fair enough. All right, so I want to jump in a little bit more in terms of like, so you have the course, and obviously I'll link up the articles, I'll link up the web, the blog, all that kind of stuff, so people can go listen, check it out.
I appreciate that.
Yeah, and if they're in time for the course, if not, you can sign up for the newsletter thing, which is what I've done. So I'll get a message whenever the course goes live. But in terms of like, I guess, so like you explained kind of the way that you can do stuff with like separate companies, or, you know, like a parent company, like kind of like what Google did with Alphabet, obviously on a much smaller scale. But in terms of like, let's say people do that. And I think the point that I'm trying to get across is to people that are listening is most people, at least that I know and that I've spoken to, don't invest, period. Like their best investment strategy is, I have a savings account that pays me 0.1%, right? So in terms of like when you do all of that stuff, so you've got, let's say you've set up a separate account, you've took, you know, £10,000 or whatever you took, the amount of money, you've put it in this account from your other business. And now the options are like what is it that I could do with that money? Like, what are some good options? Or at least what are the options? I suppose good is dependent on who's doing it. And kind of like what returns could you see? And obviously, like, it's super subjective, but I think the point that I want to get across is that, like, you could take that money that's doing nothing and earn more than 0.1% on it doing something else.
Yeah, no, it's a fair point, Rob. And I think, like you rightly said, and I probably always miss it, is that the first point is educate yourself on investing and try to understand what it is. And because most people will probably just, as you said, have a savings account, and perhaps they'll try to buy a house and put the perhaps overpay their mortgage or something like that. But there is value in seeing what's out there and what else you can do, right? So once you have educated yourself and you have understood the benefits of investing and what it can do for you and your family, then what are the options? There are plenty of options. For limited companies, there are still options like individuals have. And one option is to invest your money in the best businesses of the world in the stock market. Right? Most businesses are listed in the stock market, and you can easily and cheaply these days buy a fund that invests in thousands of companies around the world and benefit from the economy and from the profits. As a shareholder, you get paid dividends, you get paid a share of the profits. Sure, there are ups and downs, right? But historically, this has provided around 7% return per year. Again, historically speaking. And you can let your money grow this way in a very passive way. You can also do more research and pick individual companies. Although personally, I don't do that. I think it's definitely a hard thing to do. And I don't have the knowledge, right? And then you can invest in other things. A lot of people in the community invest in buy-to-let. And let's be honest, buy-to-let has had an amazing run here in the UK. In the past 40 years or so, that interest rates kept dropping, and the price of money became cheaper, so interest rates kept going lower and the asset prices kept going higher. So you had this explosion in house prices, and buy-to-let can help. It also pays the rent, so you have the cash flow element there. So limited companies can buy properties, they can buy units, and they can invest this way. Of course, you can buy other things. You can buy gold, you can buy commodities, you can buy gold ETFs as well. So those funds that invest in and hold gold or silver or other commodities. You could buy crypto as well. I know that a lot of people are interested in crypto, and limited companies can hold that as well. So I'd say you can buy a lot of things that an individual can buy. Perhaps there are certain investments that have certain tax benefits for the individual, like, let's say, investing in small startups and offering EIS and some schemes there that offer tax breaks for individuals. But limited companies overall can have better tax benefits when it comes to taxation when you're a higher taxpayer. And if you have maxed out your 50K a year salary and dividends, then you enter the higher taxpayer territory. And sometimes, because limited companies don't pay income tax, they pay corporation tax. Corporation tax can be lower than income tax, depending, of course, on your band, right? Depending on the person. Personal finance is after all personal. But limited companies can invest in a wide range of investments, including bonds that they forgot, of course, very important, bond funds, and other things like peer-to-peer lending and perhaps property lending. So you lend to developers that want to build something and then pay you interest, things like that.
Okay, all right. So a couple things on that. Because I know you said earlier that, you speak to a lot of people about this stuff, and obviously through the community and stuff you do as well. Like, what are some of the more common questions or misconceptions people have about this kind of stuff? Like, so for example, like me, when I speak to people about anything to do with investing, the first thing I get is like, oh, but I could lose money, right? it's like, well, you know, theoretically, yes. And to the point that you said, like, if you invest in a fund that is, let's say, you know, you buy the UK stock market fund, like, yes, you could lose money, but then it will go back up. And I always think of it, and this may be right or wrong, but my personal thinking is like, the only way that I lose money, assuming that I'm in it long term and not short term, is if the stock market goes away. And if the stock market goes away, I've got bigger problems than I lost, you know, whatever it was that I invested, because essentially that's like the end of the world, right? So what are some of the more common questions or misconceptions that people come to you with around this kind of stuff?
I'm not sure why, but I'd say that this question is less asked in the community. Perhaps people that join the course know have an education about investing, so they have done the research already. But it is definitely a valid question. Like you said, you know, if you study history, then you can tell what risks you are taking, right? So how yes, you can lose money, but that's only if you sell earlier or if you don't make the right investments. So you know, choosing the right investment is obviously quite important, but once you understand, you know, how the tracker funds work and the global funds and how the economy always grows, sure, there are contractions and short-term bumps, but at the same time, you know, long-term, if you see long-term, you can definitely make more. But as a common misconception, I think in the community, I'm not sure. Actually, we can cut this one because I don't think I have a good answer for a common question, misconception, let's say.
Yeah, that's totally fine. All right, so I have something else that I also wanted to ask, which again is like a general question. So just this is your opinion and my opinion. And I guess for anybody listening, I always hear this on podcasts and stuff, and I'll put a disclaimer at the front, but for anybody listening, like, this is not financial advice. This is educational advice. So definitely, if you want to do anything that gets talked about in this podcast, go and talk to somebody that is able to financially advise you, because I don't think either of us want to get in trouble. But the question is, in terms of this stuff, like, so someone's listening now. So, for example, I sent you an article about setting up a company for investment to a friend of mine. And like literally the next day they spoke to their accountant and said, I want to do this. And their accountant set them up a second company. And now they're investing in, you know, whatever. Nice. And they were super excited about it because they were in the same position as me. They were asking me questions like, what else can I do? And I was like, well, you're doing all the things that I know about. And then I happened to come across you and I was like, oh, there's another thing you could be doing. But I say that to say, if people are listening now, and they hadn't thought about, you know, oh, I could take some of this money and I could invest it in, you know, Bitcoin or funds or whatever I choose. Is now, in your opinion, a good or bad time to do that with so many people across the entire world? Like, oh, we're about to come up to a recession, you know, recession's coming. Like, I've been hearing that for at least 6 months. And it's always one of those things, like, people say it and I would believe it to be true, but you don't know when it's going to happen. Like, it could be tomorrow, it could be a year from now. So if people are listening and they want to do it, is now a good time to do it, do you think, or not?
It's a tricky question. I mean, and I'm definitely not. I think anyone that tells you what's going to happen in the next 6-12 months, is probably a liar. Okay,
agreed.
Because it's impossible to predict not only how events will unfold, but also how to time your investments, right? Yeah. Because the trick is not just to, even if you predicted 100% what's going to happen, you can still not predict equally well how investment is going to fare, right? Yeah. Because think of COVID, think of March 2020. Yeah. The world was going through a crazy time. Yeah. And all the markets were in free fall. Yeah. All this, the stocks were down, and suddenly 23rd of March, I think, in the middle of the chaos, you see the stock market starts climbing up higher and higher and higher without reason, and the news became darker and darker, stock market, went higher and higher, which was crazy to see, right? But it goes to show that you cannot really time these things. So is now a good time to invest? I don't know, but if I had to, but the good thing about investors, at least regular contributors, is that what they can follow the saying, it's about time in the market, not timing the market.
Yeah. Which
means that if you invest regularly and assuming that your entire lifetime income is not in your pocket right now, so you still haven't got hold of it, then you can actually benefit from a falling market while you invest. So will the market fall further? I don't know. But even if it does, if you invest with a long time horizon, let's say at least 10 years from now, and you invest in the entire market, so you basically pick the funds that that can benefit from a cheap and let's say the passive investing that I follow is definitely something that I find very interesting. But that doesn't mean that everyone should follow this approach. But what I'm trying to say is that if you have a long time horizon and if you can invest regularly, then you can actually benefit from the downturns, the temporary declines that the market will give you. And for a young person, it's actually better to have the declines in the beginning than at the end of the journey. Because if you start investing and you see decline, you're buying more units for the same amount of money. You're simply buying more. And then you have a tailwind. Whereas if you face the downturn later in your life, you have invested, let's say, for, 10, 20 years, and then suddenly the market crashes by 50%. 50% on £1 million is different than 50% on £10,000. Right?
100%.
So your wealth definitely, the downturn is the same in percentage, but in nominal amount, it hurts a lot more. So I'd say that, for people that want to start now, one thing is to, understand how long-term can help you, and also to take a more defensive approach if you just don't have the risk tolerance for it, right? Because no one has to be in the stock market 100%. You can take a more defensive approach, add bonds into your portfolio, diversify, add some property, do some other things like with your investments that are not as risky as the stock market is. So I'd say that you have a long time horizon, so as a particularly young investor can benefit from this approach, and B, if you think that you're gonna panic and sell at the bottom once your investment is minus 30 or 50%, then just do it, take a safer approach. And also if you have but then the question becomes like, okay, if I have a big sum in my company, then what do? Do I invest it all right now? Should I not wait for the recession to be over? You can take the more staggered approach and just invest in tranches over the years. No one has to invest all the money at once. Even though mathematically this might be the better option, but that all depends. And investing is, I'd say, half psychology, half art, half science. So it's definitely personal.
Yeah, I would agree. I think the dollar cost or pound cost averaging, however you want to term it, is like the way to go, at least personally, because like you said, you might end up buying high this month, but you end up buying low next month, so it averages itself out. Because like you can't time the market. I remember there was a study. I think I've heard this on like a Radio Lab or a Freakonomics episode where they were like they did a study where they had a monkey. I think it was like it was something to do with a monkey, and it was like throwing darts at stocks or something on a wall, and it basically predicted just as well as professional investors which stocks were going to go up and which stocks were going to go down, which goes to show that basically it was chance. So like some investors do really well, a bit better than like chance, and other investors, but either way, like you could just toss a coin 50-50 and you're likely to hit the same results. So like I would definitely agree, at least personally, dollar cost averaging. But then also I was going to say, like in terms of time in the market, like I've definitely fallen into that trap. Like recently as well, it's like January Ethereum price dipped dramatically, and I was like, all right, cool, I'm going to buy Ethereum now, thinking like this is the bottom. And then the next day it went down like another 25%. So it's like, all right, cool. So I definitely shouldn't have, here's my money that I want to use for Ethereum. If I dripped that in slowly, I would have got the low price, then the lower price, then the lower price. And then I did the same thing with Netflix this year. So like Netflix dropped like 70%.
It dropped massively.
Yeah. And I was like I everybody I know uses Netflix, right? So however bad the investors think the company is doing, I don't ever see it going away. Like it would be a weird thing to go home and people just don't have Netflix. So I was like, oh, I'll invest in this. And then the next day it dropped a little bit more. So it's like now it's your gain. Like I can see it going up, but it's going up lower than what I bought it for. So I'm still not breaking even. So it's like, averaging it out and not trying to time the market and being passive is like great advice. But I kind of want to start closing it out a little bit. But for people that are not limited companies, right? So there's a lot of people listening now that if you're not freelancing, like hopefully this is a little bit more encouragement to maybe go that route if you choose to. But for people that are listening that are employees, so they don't have that, excess salary that they haven't withdrawn, everything goes into their bank account. What are some options that you would recommend for them, or like what are some options for them other than just, your standard, I just left it in my savings account and it makes me, £10 or dollars a year?
Yeah, I mean, the savings accounts don't pay that much, as you rightly said. But I just want to say a quote from I think Morgan Housel from the book The Psychology of Money, which is an amazing book, by the way.
Yeah.
Save like a pessimist, invest like an optimist.
Yeah.
So this is a very, very good quote that I like that describes the situation where you need to keep low expectations when you're investing, and so you definitely need to save money for it, and then even though you save like a pessimist and you think that the world will enter a recession, also invest like an optimist. So invest in income producing assets.
Yeah. So
don't just leave your money in the bank for 10 years earning nothing, because let's be honest, inflation, we had a good run of low inflation, but now things are changing. So right now inflation runs at 10%
it's crazy.
A year, which is crazy here in the UK, and it's in the entire world. It's not just the UK, of course. But yeah, keeping your purchasing power is key, and particularly if you see it in the amount of in the 5 years time, this 10% a year can cut your wealth in half. I mean, it's so But overall, I'd say that investors that are not freelancing, so payee employees, can definitely take advantage of the tools that are available to them. So use an ISA for your investing. Use tax-free wrapper, so you don't pay. The government actually incentivizes you to invest and to save for your future. So there are different types of ISAs. There's a cash ISA that just gives you a little bit of interest. There's stocks and shares ISA that they can use to invest in ETFs, in stocks, in bonds. There are other types of ISAs if you're a first-time buyer, and the innovative one. But other than the ISA, I'd say that think about pension contributions a little bit more, because they're basically free money. Seriously, they. Especially the companies that offer a matching contribution. So if your company, let's say, offers you a 5% matching contribution, what does it mean? So if you put 5% of your salary in your pension, then they will add another 5% on top of it, right? So they'll match your contribution. That's basically free money from the company that you work for. Plus, your money can grow tax-free in the pension wrapper. Plus, you don't pay income tax because you don't take it in your pocket. You defer the income tax for later. You don't even pay sometimes national insurance contributions on it. So basically the government says, you know what, use your pension. This is a tool that you can put up to £40,000 every tax year. Just use this tool to save for your future, and you can do so in a very tax efficient way, particularly if you're a higher taxpayer. So developers sometimes earn more than £50,000, so they would benefit a lot from the 40% contribution on top of their of what they would have in their pocket. So these are the two tools. There are definitely some more advanced tools, not tools, but advanced vehicles, let's say, like the EIS and the VCT funds that I think they probably it's like the Pareto principle, so 80-20. So 80% of your outcome will depend on 20% of the effort. So I think with just the 20%, you can get most of it, most of the gain that you can, not only from the tax side of things, but also from the investing side of things.
Yeah, 100%. Okay, cool. All right, that's really interesting. All right, so I want to wrap it up. I'm going to bring it a little bit back to coding because that's why a lot of people listen to this podcast. And so the question that I like to ask everybody, and I'm going to ask you because I find it interesting, is what do you think separates an okay developer from a great developer?
The ability to eliminate. So that would be my answer. An okay developer would write some code and wouldn't ask the question like, is this needed, what I'm writing? Or versus a great developer that would look at code and basically sometimes just fix it by removing things rather than trying to fix it by adding more function and more classes. So I would say that a great developer will take a step back and always ask, why am I doing this? Is this needed? Can I remove things? Can I make the process simple? Yeah. Simplicity is key. Yeah. And I think a great developer understands that and tries to eliminate more than they add. So that would be my answer.
Yeah, that's a good answer. Yeah, it always comes down to, generally in coding, like the simple solution is always the best solution. And when you end up with that solution that could be one line of code and it turns into 100 lines of code, then you've done something wrong. So yeah, that totally makes sense. All right, cool. So then last question, where can people find you online? Where can they find your blog, your course, all that good stuff?
Sure. They can find me on FoxyMonkey.com. So that's the blog URL. They can also find links to the course, which is at companyinvestingacademy.co.uk. But basically, most of the course material is, I'd like to say that it's on the blog already. So you can go to foxymonkey.com and find out more about company investing, like your friend, talk to your accountant and do this stuff. The course is more about a structured way of doing this, me teaching it, being in touch with the community and talk to other similar people. But I'd say that most of the stuff that's there is free, and I wish if people want to reach out, just send me an email. You'll find my contact details there on foxymonkey.com. So yeah, happy to.
All right, sweet, cool. Is there anything that we didn't talk about that you wanted to, or anything I didn't ask that you wanted to talk about?
I don't know, perhaps, the book we covered, I threw a resource there that I was thinking is a good resource for people to find out more about investing. Smarter Investing is another book, actually. Okay. I was thinking, I'm not sure if I should tell people about it. You have a question that you asked as optional, like what are some fun or noteworthy moments in your journey? And as a coder, I was kind of obsessed with blackjack 10 years ago. I wanted to be an advanced gambler, and I thought, I'd actually create an automated system to not go to the casinos, because blackjack is a game that you can beat the casino, right? And as long as you have the memory and the skills and the practice, most of it is practice. Is
that card counting? Is how you beat it?
Yeah, it's card counting, exactly. Okay. Yeah. So I implemented the card counting strategy, and I really wrote a lot of code on it in different language. I'm a Java developer, so I wrote it in C# because I wanted to learn. Okay. And perhaps I could highlight that as a fun moment in my journey, that I wanted to automate it and put it in live casinos, because there are online live casinos. But in the end, the most time-consuming bit was actually the interface that would detect and place the bets and make sure that everything is done correctly, rather than writing the actual algorithm that beats the casino.
Oh, really?
Was a surprising finding, if you ask me.
So did this tool work? Because I was always under the impression that with stuff like that, like, because it's software, like the same rules don't apply in terms of, like, yeah, sure, they're using a 52 card deck or whatever they're using, but they could, like, the rules that apply in real life when you can do card counting doesn't necessarily. I always thought it didn't necessarily apply to, like, online, because, you know, they could just shuffle the deck every time and you would have no idea because you don't see it, right? So did the tool that you built actually work to do that?
It didn't work for a different reason.
Okay.
It didn't work because the interface. We never finished the interface that actually implements the strategy and places the bets and everything.
Yeah.
But it would have worked because there are some live casinos there that you can do live. It's as if you're in the casino.
Yeah.
At least back in the time, you had to look at. You seem to know a lot about card counting, Rob, right? So there were casinos that I think were dealing with four how do you call it, with a deck that you can count, basically. Because if they just shuffle every round, then you cannot, the system doesn't work.
Yeah, that's what I was thinking. All right, that's interesting. So I assume this was like a hobby of yours, was the blackjack thing, right?
Yeah. That was me actually reading 3 books on blackjack. I can get rich by just coding something that can bet against a live online casino, but the interface was actually the hardest bit. That was a surprising finding.
So, but how come you didn't finish that? Did you just lose interest, or was it, like, too difficult at that time?
Yeah, I think it was too difficult, and then I just quit.
Okay.
It was too difficult to also customize it to different interfaces, because casinos have different interfaces.
Right, yeah.
So, but even as an MVP, the backend was done, but then the actual front end was left behind.
Okay, all right, that's super interesting. I assume, and so now I'm super interested, right? So I assume the concept of this was like, you just log in somewhere and then you just leave it, and you come back in an hour and it just plays for you. That's
the thing. Yeah,
that's cool. Okay.
The other hard thing about this was the pace that they play is quite important. So they play really, really slow in live online casinos. I don't know why. Although the incentive is actually to play fast, because that's it's more profitable for the casino.
Yeah.
But they play really slow, and this definitely hurts the profits. So it's a combination of things that I actually thought, let's quit, do something else. That's too much work.
All right, brilliant. And then you found a safer way to gamble with your company's money, I would say.
Exactly.
Sweet.